to today's video, I want to talk about a very powerful strategy we can implement to generate some nice weekly income, guys. It's very easy to set up, very easy to follow. So let's get right into this video. So first of all, I'm going to be using Snap for today's demo. So let's go over to Snap here. And by the way, this is just an example I'm showing you guys. Please don't follow this exact same trade. This is just an example. Now we're going to go over to the options here for Snap. So trade Snap options. And here we are on the options available for this stock here. So first of all, let's talk about what our goal here is. So our goal here will be to profit from neutral stock price action, where the price will be near the strike price of the options that we're going to choose. And I'll show you guys that here in a minute, with limited risk in both directions. So ultimately the forecast should be a neutral forecast, or modestly bullish, modestly bearish, meaning that types of stocks we want to use for this will be stocks that usually trade sideways, that stay kind of in a defined range. They could go up a little bit, can go down a little bit, as we'll see, but for the most part that they trade sideways. So in other words, stocks with low volatility. And so again, I'm just using Snap as an example, completely random. I'm not sure if it's volatile or not, but that's what we're going to use here. So here's what the setup is going to look like. So the first thing we need to do is we need to determine what price we think this stock will be at on expiration date. So for this first option we're going to choose, usually for the expiration date, I like to go 1 week out. Some people like to go 2 weeks out, a month out. I think 1 week out for me makes the most sense here. So I'm just going to leave it as May 21st. So the first thing I would do here is take a look at Snap and say, what price do I think Snap will be at on expiration date May 21st? So let's say I think Snap will be at $55 on this expiration date. So what I'm going to do then, and we're going to be using puts here. So we're going to go to puts. I'm going to go ahead and I'm going to sell a put at that price. So if I think Snap will be at $55 on the expiration date, I'm going to sell a put at that 55 strike. Now remember, for selling a put option, you receive a premium. So for selling this put, I'm going to receive $1.41 per share. Each contract controls 100 shares. So I'm going to receive $141 for selling this put option here, okay? Now, remember, in order to sell a put, you need to have enough collateral in your account to put up. Well, let's pretend that we don't have that much money, and let's assume that most people aren't going to have that money there. Well, we need to do something else then in order to actually be able to sell this put. So then what we're going to do here is we're going to go about a month out. So I would go to about June 25th, and then I would go back up here. And then here, what I'm going to do then is I'm going to go ahead and buy a put. And I'm going to buy a put at the exact same strike price I chose for the put that I sold. So I'm going to buy this put here. Now remember, when you buy a put, you have to pay to enter this trade, right? And you're going to have to pay $3.68 again per share. Is 100 shares in each one of these. You will have to pay $368 for this put. So I'm going to click on here. So as you can see now, this is called the long put calendar spread. I've talked about the long haul calendar spread in the past, but I want to talk about the long put calendar spread here today. So total cost for this will be about $226. Now, what's pretty interesting is that I actually just got this new feature that Robinhood added. I know some of you guys have had this for a while now. This is basically the profit loss chart here, which is pretty nice, pretty handy. I mean, it tells you what your max profit is. Max profit could potentially be, what your max loss will be, your break-even points. I mean, I'm still going to use the options profit calculator, but this is kind of a pretty nice chart here. And I also did actually go ahead and set up the long haul calendar spread over here, just to kind of show you guys what this looks like. So let's take a look here at it. So this is the long haul calendar spread, as you can see. So they're going to be very, very similar, guys. If you take a look at the profit, max loss, break even, they're going to be very similar. And I'll make a video in the future kind of talking about what the similarities and differences are. But I just wanted to show you that, guys, here very quickly. Now, our max profit here, of course, is very impossible, very hard to really know what it is because of the fact that the price of the long put, right, the put that we're buying, this is going to vary depending on what the volatility is, right? When volatility changes, the price of it is going to change. It also depends on what you do after the short put expires, and we'll talk about that here later on. But our max loss is defined. That will be the debit paid to enter. What we're paying to enter. We're paying $231, and this tells you here as well, right? Your max loss $231. Which is just going to be the cost of this spread. So now with that being said, let's go to the options profit calculator. Let's take a look at what this trade would look like. So I'm going to go over here to the options profit calculator. Again, I always recommend using this to visually see what your trade looks like, what your profit or loss will be depending on the date, depending on the stock price. And they actually have a calendar spread calculator already for us. So we can just click on this link here and we'll go here. So let's take a look here. So again, we're going to basically set up the exact same trade we just set up over there. So we're using Snap. We can click on get price to get the price of Snap. And then the back month, we're actually writing or selling for that. And so we sold the May 21st expiration date. So make sure you're choosing the correct expiration date. And then puts are on the right, calls are on the left. Don't get that confused. So we chose the 55 strike, which is right there. And then we're buying over here, the front month. So we'll go to June 25th. And again, puts are on the right. And we chose the same strike, 55 strike. So again, this is in the net debit. We're paying $233 here to enter this long calendar spread with puts. And let's calculate this. Let's take a look at what this looks like. And so let's take a look here. This is loading, taking a little extra longer than usual. So there it is, and let's take a look here at what's going on. So our entry cost is going to be a net debit, $233 here. And so if we take a look at our max return, it's going to be about $119. Probability of profit tells us it's about 70%. So it's a pretty high probability. And if we actually take a look here at this chart, we can see that as we mentioned before, right, we want this stock to trade sideways, but it can be modestly bearish, modestly bullish, right? It can go up a little bit, it can drop a little bit. We're still going to make some money, but our max return will happen at a price of $55 on expiration. And that's not just a random number, right? That is actually the strike that we chose for the put we sold and the put we bought. That's why we first start with, kind of trying to determine what price we think the stock will be at on the expiration of the put we sold, because that's the price we actually want this stock to be at on expiration so that we can make that maximum return of $119 here, which would be about a 51% return. If you take a look at the break evens, they are pretty far apart on expiration. I mean, you have a pretty big range where you can be profitable. And again, especially if you're choosing the correct stocks here, stocks that do trade sideways or that, go up, down a little bit, stocks with low volatility. But this is what this would look like. Now, this shows us up until the short put expires. And that's kind of the next thing I want to talk about. So when the short option expires, right, which would expire on May 21st, kind of have three options at that point. You can either A, sell another option for the following week. Of course, make sure that you check on options profit calculator, what that's going to look like. Make sure you're comfortable with, where the price needs to be for you to be profitable, things like that. The second thing you can do, of course, I think a lot of people maybe do this, is that you can close the entire position in general. So you can close out of the put you sold, you can close out of the put you bought and just be done. Take your profits if you do have profits. Or the other thing you can do, the third thing you can do, if you are bullish on Snap, you could just leave the long put option, right? The put you bought, and just let it, be alone. And, if you're bearish and stock does drop, that put will, of course, increase in value. So those are kind of the three options you have once your short put option expires, right? Now, this is a theta gain strategy, right? This strategy does profit from theta decay. Reason being is that we're selling a put and then we're buying a put. But since the put we're buying expires way further out, the theta on the put we're selling is going to be a lot higher, because remember, theta gets higher the closer that you are to expiration. And so since the put we're selling is a lot closer to expiration, theta will be a lot greater on the put we're selling. And so even though each day that this trades sideways, for example, we are losing some money due to theta decay in the put we bought, we're making a lot more money on the from the theta decay of the put that we sold. So this is a theta gain strategy. We are profiting from theta decay. Now, the last thing I do want to mention here, guys, of course, is the risk of assignment. So we are selling a put option, right? Anytime you sell an option, there is a risk of assignment. Now, it's very rare to get assigned before the expiration date. It's only happened to me once in the last 2 years that I've been doing this. But early assignment generally is related to dividends. Specifically, they are going to be assigned on the ex-dividend date. So when if you're selling any option on a stock, you should always check for the ex-dividend date. And if the ex-dividend date falls on the week that that contract expires, there is a big chance that you will be assigned early. And so to avoid that, you can either just, completely avoid selling options for that week on that stock, or you can close out, I would definitely say, about 2 days prior to the ex-dividend date, just to avoid having to deal with early assignment, guys. So anyways, this is the long put calendar spread. Again, very, very similar to the long call calendar spread. And I'll make a video in the future comparing both of them. But again, it's pretty nice that I finally can look at this. I know a lot of you guys have been able to see this profit and loss chart for a while now. So definitely take advantage of that, but I still recommend using the options profit calculator. So if you have any questions, feel free to leave them in the comments section below. Check out the Discord and BlockFi, link to those in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.